Ready?
Ready.
Here we go.
Locked and loaded.
Welcome. You're listening to The Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'd say very valuable information. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hunt of Pacific Private Money, California's fastest growing private mortgage investment firm, and Rob Spinoza of RPM Mortgage. And today's trivia theme is, what are my three favorite colors? No, I'm just kidding. Is which television mother was I? Okay?
All right.
You'll understand.
Interesting.
Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show, and we're also on television. You'll find us there. Mark, you guys, before air, were we talking about Prop 13?
Well, you know, we like to talk about investments on this show, and investments include pretty much all of us who own real estate, whether residential, and many of us also own, commercial real estate as well. So, the California government is, or I should say some of the politicians in Sacramento have gone back, or going back again to that, well, I guess it's that age-old, enemy, Prop 13.
Yeah.
And why is it an age-old enemy? Well, because there's this belief that, after, how many, was it been 25 years now, or 30
No more
years?
than that.
It's
Yeah,
been more
it's-
than that, right?
1976.
Okay.
Yeah,
I was
so
going to say 35.
So 35 years-ish of Prop 13, that it's caused this, huge disparity and unfairness among various property owners.
Right.
I mean, if you move into a neighborhood, that a mature neighborhood, you could be, and you pay, let's say you pay $1 million for your house. Well, maybe
Right.
your neighbor is in that house for $200,000, and it's a huge
Right.
difference in tax bill. One guy's paying, $2,000, and the other guy's paying,
Literally.
Now, to give
$10,000.
a little
So
history lesson.
Right,
the
right.
reason that it came up was because real estate prices were starting to go up,
Mm-hmm.
and there were older people in their houses. They
Yeah.
couldn't afford the taxes. They were being basically taxed out of their house.
Right.
And so they
My
said,
house is free and clear, but I can't afford the taxes. and I'm
Yeah,
out.
yeah.
Right.
What do they call it? Cash poor and real estate rich. So what they did was they said,
Yeah.
well, let's institute this. If you, we can only raise your taxes 2% a year.
Right.
2% a year.
Right.
So it's 1% of the value of your house is determined by the purchase price, or plus 2% per year.
No, but that's
Well,
not
plus
just
the
1%,
bonds
plus the
and-
bonds,
yeah.
plus
Right.
that and the other thing.
The mosquito vector control and
Yes,
all that.
exactly. yeah.
But the gist of what Sacramento's looking at doing again is they're not looking necessarily to eliminate Prop 13 for residential property, but for commercial property.
Wow.
And so the idea is that, for example, in California, where you've got apartment buildings where one apartment building has been in the family for decades and decades and decades and pays very little property taxes.
Right.
And then right down the street, you've got, or in another neighborhood, you've got a similar apartment building that just traded for multiples of millions of dollars, and they're paying,
Right.
hundreds of thousands of dollars in property
So
taxes.
here's the solution. Just lower the taxes of the guy who's paying too much. Don't raise the tax of the people who are paying
Wow.
too low. How's
So
that?
the idea is to revoke the, basically that Prop 13 treatment for commercial property. And so, here's the thing: there are no easy solutions.
There's no
right?
easy-
and
very
I
complicated.
understand the disparity of it. I really do,
Right.
and there does seem to be some, inherent unfairness in that you've got two identical properties, and one that's just been in the family forever, and they're not going to sell it, and yet the one that's traded recently, that they're paying their full share. How can the guy that just paid for it, how could he compete with the guy down the street in terms of rents?
Yes, but think about it for a minute, though. If, in theory, one would think, then again, this may be like a trickle-down theory, but the people who have kept their real estate tax base low
Right.
are keeping the rents relatively
Right.
low.
Right.
So, what are you going to do? That suddenly now you're going to get rid of rent control, or are these people going to turn into slum landlords? You know what I mean?
Yeah, absolutely. I remember trying to explain Prop 13 because my family's not originally from California, so I was trying to explain it to someone not from California. And so as I was educating myself about it, I became aware of all of the socioeconomic implications of Prop 13.
Yeah.
Just exactly what you're talking about. I mean, you get these great disparities. Who's right and who's wrong?
Yeah,
It's very hard to know.
Well, then you get into Prop 8, which allowed people to get their taxes lowered,
Mm-hmm.
right? But for some people who were, already at a fairly low base, there was nothing for them to do,
Mm-hmm.
right? Like, people, like you said, a mature neighborhood, so
Right.
they paid $200,000. Their tax base was so low anyway.
Right.
There was nothing for them to do. Well, then what happens is, as real estate prices go up, the tax assessor has the right to increase those taxes more than 2% a year.
Oh, I got it. Okay.
Until they get to the part where they were before. Then they can go 2% a year. So it's a thicket.
Well, and then the other problem is Rob, you brought in an article that is a national article on property taxes, and nationwide, property taxes are only going one direction.
Right, and that's up.
up,
Yep.
up. So, do you really want to give the keys back to those folks in Sacramento who really were the cause of Prop 13 to begin with? And obviously it's not the same people there, but politicians haven't changed in 200 years, if not in 2,000 years. So, I don't like the idea of saying, well, we're going to exempt commercial property, and then that just becomes another asset class that is going to be abused by Sacramento.
Well, here's the other thing. What about like nonprofits, like churches and all that?
Yeah.
They don't pay real estate taxes at all.
Huh.
And there's a big push for those guys. But then, in theory, they're supposed to be helping the poor and all that. So
Well, right, by their charter, yeah. I thought you were going to go in the direction of a 1031 exchange, because at that point, I mean, you still have that tax shelter in place. So if you've got a commercial property, you're looking to, and you sell it, and then you buy into another one, you get a benefit there. I know not the same thing exactly, but still. Addressing the commercial issue or investment
but
issue.
you don't get the tax.
No, not the tax basis.
No,
I'm just
no.
saying, but it's another sort of tax.
Yeah.
Right, real estate has a
element to
number
it,
of
right.
tax benefits, because the belief is that the real estate market component of the gross domestic product,
right,
or at
right.
least the GDP, and particularly in California, it's very, very important. It's a major part,
Well-
very strong, and so a vibrant real estate economy is important. And so you've got these various tax-favored treatments.
As real estate goes, so the economy goes.
So,
right?
and we see this coming up more and more frequently now, because Fannie and Freddie have been on the congressional chopping block, and they're trying to determine the future of the government-sponsored entities. And when you start talking about this, you can't have that conversation without involving, where is government involved in housing? One of the reasons that Fannie and Freddie have been, have this giant bullseye on them is because they're quasi-government entities. They kind of straddle the public and the private sector, and people don't like that because they can't identify who's on the hook for what. But at the end of the day, the argument I see being is one where it is, where does the government get involved in housing? And of course, you've got people on one side of the argument who say, oh, government shouldn't be involved in any part of housing. To them, I say, well, if that's true, then should government be involved in the paving of roads and building of bridges? Because if they're not, we've got a very different America. And I believe that real estate, and especially when you start talking about individual home ownership, is such an integral part of a vibrant economy and
Oh, yeah.
important economy. And you just can't separate the arguments, which is what I think a lot of people are having a hard time doing.
Well, Prop 13 is clearly the third rail in California
Oh, God,
politics.
yeah,
I mean,
yeah,
they're going to bring it up, and they're going to bring it up, and they're going to bring it up, and it's going to be a never-ending debate. I don't see it anytime soon
Well, it's like the
being
home mortgage-
repealed.
It's like the home mortgage.
MID, right?
Yeah,
Exactly.
yeah. So what they do is then they'll just, you pass bond measures, you tweak this here, you tweak that there, but notwithstanding the arguments in favor, particularly with commercial properties, I just don't see it happening.
You use all these initials, MID, mortgage interest
Yeah,
reduction.
sorry.
Boy,
I'm trying to save you time. Come on.
I know, now I wasted more time on that. Okay, we're going to cut to our first commercial break. Again, the theme is, which television mother was I? Now, remember...
I'm just going to give you our initials.
No. Okay, here, remember, we want the name of the mother, not the TV show.
Okay.
Okay? All right, first commercial break, first trivia question. Which TV mom had 3 daughters and 3 stepsons whose husband was an architect? The first 3 callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. Which TV mom had 3 daughters and 3 stepsons whose husband was an architect? Don't touch that dial. The Best of Investing will be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. When we cut to the first commercial break, we asked this trivia question about which television mother was I? And again, we wanted the name of the mother, not the TV show. Which TV mom had 3 daughters and 3 stepsons whose husband was an architect? Marsha.
Alice.
No, Alice, no.
Jan.
No.
Cindy.
No. Okay, what was the name of the show?
Brady.
The Brady
Yeah.
Bunch. Okay, what was the mother's name?
I can't think of it.
No.
Carol.
Oh,
Brady.
that's
Oh, wow.
Florence Henderson. Florence Henderson.
stump the host again.
That's it. Okay. You guys have some interesting articles you want to cover?
Yeah, sure.
Who's on first? No, we're just looking over these national mortgage news releases here. That a couple of great ones that Robert brought in. I'm enjoying this one. Mortgage balances increased the most since 2008. So basically, what it's saying is that we
Yeah.
have now that the total value of all first mortgages has now surpassed the prior high.
They're not talking
Right.
about adjustable rate mortgages that had.
No. Yeah, not the balances or the rates of those. But what's interesting is we've got 2 articles here. They're both going back to 2008, and the balance increase is significant in my mind because it indicates 2 things. One is the growth of new mortgages, so more people borrowing, and that hopefully reflecting more activity in the housing market.
It's all those neg am loans they came out with.
Yeah, that would be problematic. But no, most of those, and that actually gets into point 2.
Okay.
The decline in mortgage balances from accelerated amortization and foreclosure write-offs has finally been overcome by the increases.
Wow.
So you got 2 different trains moving in the right direction, which hasn't happened in a while.
So what's interesting is the number is 8 trillion. Actually, they say
Yeah, that's right.
7.97, but that's
Total
8 in my
outstanding
book. So
balance, right.
so 8 trillion in outstanding mortgages. But one thing they don't point out or they don't highlight in this article, but I think it's significant. They talk about how delinquent first mortgages are down 22% from a year ago to 5.7%. But do the math: 5.7% of 8 trillion. That's over 40 billion worth of
We are a nation
delinquent
of debt.
mortgages.
Yeah, of delinquent mortgages.
Delinquent,
yeah,
so
I mean,
$40 billion worth of mortgages in the United States, if that number is accurate,
Delinquent,
are
like
still delinquent.
Notice of default.
Yeah.
Well,
they're not
that's to say,
paying.
right.
They're just not paying.
I'm
Whether
assuming
the
it
banks,
technically could be 30 days, right?
Yeah, yeah.
So, but it makes you wonder too. Where does that all end up? Where does that how does that movie play out? Because will those end up as houses back on the market, or what happens?
well,
You probably know more about this than I do.
it's shadow inventory. It's
Correct.
a lot smaller shadow. It's certainly not the second wave that never came
Right.
of foreclosures that people were predicting to happen in maybe 10 or 11. But it's not an insignificant number. I mean, and it depending on how you count it, I've heard numbers all over the map in terms of let's just bring it to California. I've heard it said and quoted in some of the real estate blogs I read that there's still 1 million homes in California that, for all intents and purposes, are at or near underwater.
Yeah.
They can't be sold because they owe at least what it's worth.
Right.
That 5% number, I don't know how worthwhile that is, because you could have a lot of houses that have $1 million mortgage, or a lot of these houses could have $100,000 mortgages.
Right.
I mean,
right.
that's a huge difference. What we have to look at is how many houses.
How many houses are compose that total? Yeah, and I would back up what Mark says too. I see that, and to your point, Edward, I see when I see a scenario and they're looking to do something with their financing, if the house is at or near value or underwater, that has been happening. I've witnessed across the spectrum. It's not only tied to the $150,000 loan in Riverside County. It can be just as easily a house in Rancho Palos Verdes that's got $1.5 million worth of debt on it. So I think that there's more to that as well. The details, the devil's in the details.
Yeah, well, a lot of these numbers that we talk about what's happening in the real estate market right now, which is really perplexing in many ways. It reminds me, because I'm old enough to remember, of the 80s when we coined the term stagflation.
Yeah, interesting.
And so what do I mean by that? Well, you've got a market that, we had 25,000 housing units sell in California in February, when a healthy market is over 40,000 units. We're nowhere near selling the kind of units per month that a healthy California market would expect to see, and yet housing prices in many markets have now exceeded the prior high from 2008. We had double-digit growth in price appreciation in 2013. Yet, for all the people that want to buy a home, they can't because there's not enough inventory. Home builders are not building and adding to the stock. But you got an article here that says the value of mortgages in America is now higher than the prior high, so that must be a good thing, I guess. But if you want to buy a house today, or rent a house today, in California or in the Bay Area particularly, good luck.
Yeah, it's hard to draw conclusions from a lot of this.
Yeah.
I have some stats here from San Francisco, and I realize it's highly localized, but 2 in every 5 sales sold for 10% or more over list price.
Whoa, wait a minute.
Yeah.
That's 40%.
It's 40%.
So in San Francisco, 40% of sales are more than 10% over
the
asking?
Over list price.
Over the list price.
So list asking, but 1 in 6 sold for 20% or more over list price.
That's just
that's
astounding.
Yeah.
And how recent is that?
That is February.
Because I remember
Ending
last
mid-March.
year,
Yeah.
it was there was this frenzy.
Yeah.
It seemed to cool down.
Well, again, I think that reflects lack of inventory.
City is tough, yeah.
And the competition among people with wealth, and that's, again, the 1% argument, all those people who are making a killing in tech in San Francisco, and the tech industry in San Francisco is the dominant industry right now.
When you say lack of inventory, the houses didn't disappear per se.
Well, right, but
So what is going on? People just aren't moving?
There's not as many listings as there were in what would be considered a healthy environment, because I think it's still because when you don't have prices that are higher than the high of 2006 and 7, you've got people trapped with not enough equity to sell.
I also think there's another thing afoot here, and it goes into the stock market mentality. You've heard, no doubt, you guys have heard the old adage, sell your winners.
Yeah.
That's a very hard thing for people to do. More people are inclined to sell their turkeys, which is why they get out of the housing market when prices are down. But the other thing that I think is happening here in the Bay Area is that homeowners are witnessing this appreciation. They may have passed the 2006 watermark, and they're like, cool, we got back to where we were. Let's ride this thing out as far as we can. It's like having a winter stock, and you're looking at the value go up day after day or week after week, and you're thinking, I'm going to hold on to this as long as I possibly can. Eventually, you could risk ending up on the wrong side of that equation. But in real estate, you don't have the liquidity that you have in a stock market, so moving out of your house is a big deal.
Well,
and you can't play it that way.
And lack of inventory or low inventory is a self-defeating cycle, because then you've got a situation where people won't sell if they don't believe they can find another house to buy. So they're looking to. So what's happening now? The trend now is, and this is different. This is new historically, and that is, you buy the house you want to move into first before you sell the house you're living in now.
And not too many people can qualify.
Right.
So I could imagine Mark Honk's doing very well.
We get a lot of private money loan applications from people who are looking to buy their next primary residence first before they put their existing one on the market. That is a very brand new trend based on the lack of inventory and the fear that they're going to sell their home and not be able to buy another one.
Right.
Yeah.
And to do that, what we call that in the residential mortgage industry is a departure property. So depending on your equity position in the house you're leaving to buy the new one, will determine whether or not you can use proposed rent on the new property, if that's what you plan to do. But where you're talking about a true situation where you're just trying to get into a new primary home, you end up in a bridge situation if you've got the equity to do it, and you've got to try and work that angle to make it go.
All these fancy terms, MID and departure property, and pretty cool.
Yeah.
Well, we are now.
I'll try to think of some more and make some more up on the way through the show.
I just wanted to end this segment by just saying we are in spring. We're now officially in spring, and I shared last week how I noticed in my hometown of Novato, when I logged on the MLS, I was shocked at how many new listings there were. I mean, it was night and day difference from February to March, how many new listings were suddenly appeared on the market. So there is some signs of hope out there. So let's see what happens in the coming weeks and months for 2014.
Very good. All right. Again, we're cutting to a commercial break here. Theme is, which television mother was I? And again, remember, we want the name of the mother, not the TV show. Second trivia question, second commercial break. Which TV mother was a psychology student who had 3 sons and a husband who enjoyed power tools? I need to answer this question. Which TV mother was a psychology student who had 3 sons and a husband who enjoyed power tools. That's the hint, power tools, right? Call 888-912-1190. Make sure to include your name and your email address. Speak slowly. Spell out your email one letter at a time. Don't touch that dial. You know what's going on. The best of investing. It'll be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hanf and Rob Spinoza. When we cut to the second commercial break, we asked this trivia question. Again, the theme is, which television mother was I? And we wanted the name of the mother, not the TV show. Which TV mother was a psychology student who had 3 sons and a husband who enjoyed power tools? Now, first of all, what was the name of the show?
Not Tool Time.
No, that was the show.
Tim Allen.
Tim Allen. Okay, Home Improvement.
That's
Home
right.
Improvement.
Okay,
That's right.
And the name?
I don't know.
It was Jill Taylor.
Jill.
Jill Taylor. Okay.
Stumped again.
Yes.
Again, and the last one.
We would
you
all
might
be
guess.
sent down on this if we were in playing baseball. We would have
That's true.
Yeah,
You go
Sent down to the
D-League.
minors.
double A, maybe
Double A,
worse.
Yeah, maybe worse. Okay. Going into a little bit of emails here. Mark, we have an email from a listener who says, have any of the loans you have ever done lost money?
Hey, good question. And the answer is no. Now, look, in all fairness, I will say that when I started Pacific Private Money, it was post-real estate crash. Although at the time I started in 2008, I didn't realize that real estate prices were still
Right,
going down.
right.
Because I remember 2008 clearly, and again, I've been a real estate investor for over 30 years, since 1982. And so a lot of us in the real estate market at the time in 2008, when we saw that first wave of price depreciation, I was looking at some properties I remember in Sacramento where some new homes had sold at the height of the market for around $600,000, and suddenly they were available at $400,000. And I knew some people who actually bought them in early '08 because they had gone down in price $200,000. They thought, this is a bargain, I'm going to buy at the
Right.
bottom. Well,
And it still
those same
went-
houses went all the way down to $250.
Yeah.
I mean,
So
who
in
knew?
2009, 10,
Yes.
early 10 was probably low.
So I started Pacific Private Money to provide capital for real estate investors in 2008, after the real estate the mortgage market meltdown, as we remember, in the fall of 2008, and to provide liquidity for real estate investors. And those have been my primary clients for the last 6 years now, and we've done over 600 loans since that time. We've only had 2 loans that actually went into foreclosure, where the property actually went to auction and went back to the lender, the private lender who had funded that loan. And in both cases, they have not lost money. In fact, one in particular is Thrilled, has a great little fourplex. The other one has two single-family residences. So in both cases, and they haven't sold yet, so they haven't realized any
Right.
profits. But
Right.
their money, they both believe that their money ahead. So
Okay, but prior to that, what they call a notice of default gets filed. So how many have gone into notice of default?
I don't have that number in terms of how many times we have filed an NOD, because in some cases, in loans that I originated in the earlier years, in 9 and 10, I allowed a lot of my private lenders to go ahead and self-service, meaning I would originate the loan,
Oh, okay.
their name would be on it, they'd collect the interest, and so I don't actually
have
know.
those yeah.
But
Okay, but you do have maybe stats for the ones that you service, so you know.
it's a very low number. It's like
dozen?
it's less than
Less-
5%. I mean,
Yeah.
it's like even less than, I think it's closer to 2%
Right.
for the
Okay,
notice.
and so with the ones that didn't, okay, so only 2 of them have gone full cycle. That meant that those borrowers ended up coming up with the money, plus the interest, plus late fees and default interest.
Right. So the loans
Because you
were
got that equity cushion.
right. So the loans
Yeah.
we're originating are paying 8% or more on a monthly basis to the private lenders, and so when a borrower is delinquent, we have a 10% late charge after 10 days. So we're not really, we're not messing around. These are not consumer home loans for the most part. Most of the loans we do are to real estate investors who have borrowed the money for an investment or business purpose, and so our leashes are shorter. So 10 days, 10%, and if they go several months without paying, we have the right to exercise the default rate of interest, which on our promissory note is the note rate plus an additional 4%. So if they were paying 10%, now suddenly it's 14%. And I'll tell you, nothing motivates someone to figure out a way how to
Sell their children.
make their keep their promises than by having the default rate of interest suddenly. And again, it's not we're not this is not predatory lending, even though you might be thinking that it's that's horrible. You hard money guys are. No, it's these are guys that come to us that say, I'm going to buy, fix, and flip this property, and here's my plan, here's my budget, here's the money I'm going to put down, and so we make them this short-term loan, and sometimes stuff happens, and it may or may not be their fault, but again, we have these terms built into the promissory note to motivate action. It's not to be punitive per se or to be predatory. It's just that, look, this is a business loan. We've made a bargain here in terms of we'll provide the capital, but under these terms and conditions, you got to keep your word.
And you have the right to be gracious and forgive some of the.
Well, and oftentimes we do. I'll tell you, a lot of my lenders do not exercise. They'll even waive late fees and don't exercise the default rate of interest. But then other lenders, they will. They won't mess around. If that payment comes in on the 11th, they want that 10% added to the next bill. And again, really, my lenders generally, they invest in mortgage-backed investments because they want monthly interest. They don't want to foreclose on the property. We don't want to foreclose on the property. We make the damages or the default items punitive in nature because we want them to perform. We want them to make the payments on time. We don't want them to be late. We don't want them to go into default.
You're trying to promote efficiency in the system.
Yeah,
because if everybody starts defaulting, then you may get the sale on them, but that's not how you.
Right. And at the end of the day, we're not kicking someone out of their home.
Right.
That's the most important part is we are not kicking people out of their homes. These are investment properties, and if something goes wrong, we need to be able to step in quickly and resolve it and get that property remodeled properly and sold.
Well, that investor, just by way of example, that investor, when you impose the additional rate of interest on those loans, that investor is not like you said, he's not being kicked out of a house, but he may have additional investments that he has prioritized, and you're going to remind him, no, sorry, I'm the priority.
Exactly. That's we used to call it gentle handcuffs.
Right,
it's
right.
We want to make sure that you look at us first.
First, exactly.
Forget your credit cards, forget everything else.
Well, and a lot of people go to private money or hard money. You can use either term. They're both correct in today's market environment. A lot of people come to us for a private money loan because they would rather pay a high rate of interest and points and fees associated with getting that loan instead of going out and finding a money partner for whom they would split the profits 50-50. So look, it's not like, we're making loans to people in distress who have no other options. No. These are people that have a business plan. They're going, I'm going to get into this buy, fix, and flip market. I'm going to make profits in real estate. I could go out and find my own money partner, and we can go buy properties all cash, which a lot of people do, by the way, and fix and flip properties with my own investors. Or I could call Market Pacific Private Money, and he can get me a loan. Now, I'm not going to get 100% financing, but I've got a little bit of capital over here, or I can get money from friends or family or mom or dad or whomever. Or I do have a couple of private lenders, and I'm going to leverage that little bit of capital that we've put together by using a hard money loan to buy even more property. So again, there's a lot of ways that people come to us with their various business models, and we analyze those business models, and we've got some great repeat clients. But stuff does happen, and you have to have a strong contract, and our promissory notes are a strong contract to incentivize people to keep their word, keep their promises, and perform as agreed.
And remind the audience what you're paying out on the fund, because you have Gil Gross who endorses you. And
yeah, the radio ads on this very station, AM 910, have been great. Gil Gross has done a great job for us.
I heard that one. That was.
Well, we get calls every time it airs in the afternoons. We get a batch of calls, and we just went recently over $4 million on the fund in capital raised. We just launched the fund in early 2013, but we've got about 20 loans in the fund right now. Of course, all are performing. They're short-term loans. Two loans that we recently funded are very, very short-term. term, where it looks like the borrower is going to hope to pay us back in 60 or 90 days.
Oh, wow.
And again, the fund model really benefits our shareholders are experiencing about an 8.5% yield. And what's nice about that is that people who invest in individual notes do so because they like the control and they like the idea that they can get 9, even 10, sometimes 11%. But the problem is that nowadays it's individual note investments are so hard to find for the individual investor. They're so popular that oftentimes people who previously had a lot of their money invested in individual notes, now they're in cash. They're calling me going, Mark, what do you got? How come you haven't seen anything from you in a while? And I tell them, well, that's because I'm using my fund, and you're welcome to make an investment in the fund and enjoy some of that return. Because on an annualized basis, at 8.5% on an annualized basis, people who will go in and out of a 10% note on an annualized basis, they're generally only getting about 8%.
Yeah, good point.
At the most.
Yeah.
In fact, that reminds me, before we go to a quick break, I wanted to mention that there's a hard money lender down in Southern California who I've been on their list. And I'd say out of 30 loans, only one of them was actually even decent. And then when I responded and said, yeah, I'm interested, about 5 minutes later, they got back to me and they said, sorry, it's taken. I was like, God, why even send it to me then, you know? Okay, we're going to cut to our third commercial break here. Which TV mom's husband owned a hardware store, originally had 3 children when the show first aired, but you only got to see 2 of them later on in the series. And the hint, one of the son's friend was very cool. And again, we want the name of the mother, not looking for the name of the TV show. Don't touch that dial. The Best of Investing will come right back with a very quick, interesting email for Rob and some thoughts for the day. They're actually very funny. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hoff and Rob Spinoza. When we cut to the third commercial break, we asked this trivia question again. The theme is, which television mother was I? Which TV mom's husband owned a hardware store and originally had 3 children when the show first aired, but then you only got to see 2 of them after like 9 episodes. The hint was one of the friend's son was very cool. So what was the name of the show?
So Happy Days.
Happy Days. Yeah,
Mrs. Cunningham.
Mrs. Cunningham, what was her first name?
Harriet?
Marion.
Marion.
Okay, the bonus question. What was the son's name that you never got to see? Except after the first 9 episodes. Chuck.
Oh.
You had Richie Cunningham, his older brother Chuck, always bouncing a basketball. Okay, Mark, when we cut to the break, we forgot to tell people how to get a hold of you to get good interest rate.
Oh, sure. So if you're interested in more information about mortgage investing and how you might be able to take some of your savings, especially your self-directed IRA monies, and you want to diversify that into some alternative investment strategies for high yield, we're currently paying 8.5% from the Pacific Private Money Fund. You can actually find out more information online.
All right, and Rob Spinoza of RPM Mortgage, we have an email for you that kind of fit in with what we were talking about before.
Yeah.
Question, we're trying to buy a home, but the market is very competitive, and our offers keep getting beat by others. Is there anything we can do to be more competitive?
Oh, that is a great question. It's a very timely question. And earlier in the show we were talking about San Francisco, for example. 2 in every 5 sales sold for 10% or more above list price. 1 in every 6 sold for 20%. So what I'm seeing out there is if you are in contract or you're trying to get into contract on a desirable property, there's going to be a lot of competition for that. The agents that I've been working with on both the buyer side and the selling agents, what they're looking for are the strongest offers. Naturally, they have to go back to their seller. They have a responsibility to the seller of the home to get the highest and best offer. Now, you would think that price would be a big component of that, and it is. So I would say to this caller that make sure that your agent is structuring the deal. You're offering the right price. You're going to have to leave their judgment or leave it to their judgment to know what that is. But beyond that, what I'm seeing a lot of, and some of it is a little bit unsettling, is a lot of these buyers are going in there and they're waiving all of their contingencies. So basically they're telling the seller, I'm going to buy this property no matter what. So once you accept my offer, if an inspection that I do reveals something, I'm not holding that against you.
Pretty scary.
Pretty scary,
Yeah.
right? They are saying that if the appraisal doesn't come in, I'm not going to hold you to that.
Wow.
And finally, they're saying, even though I am getting a loan, I'm not going to have a financing contingency.
Yeah.
So we have a lot of agents coming to us asking us, look, we want to get these people into contract. Can we waive the financing contingency? Now, it's not something I would do myself, but I understand the market, and we at RPM are now offering what's basically known as a TBD approval. So a to be determined. Here you go, Edward. Another
Yeah, more initials.
More initials.
Okay, go
Another
ahead.
acronym.
I work for the TVA, and so I work for RPM actually. But a TBD approval, what we're doing that's different is we're not just giving you a pre-approval. We are then taking that file, we are giving it to an underwriter, and an underwriter is underwriting your loan as it will be approved when you eventually have a property. Now, the reason banks don't like to do this is they don't like to expend a lot of underwriting resources on things that won't go anywhere, obviously. But we're in an environment right now in the Bay Area where this is the way it is. And so our CEO has said, look, we're going to offer this to our clients, and therefore, when you go out there, you will have the option. Again, we're not telling you to do it.
All your ducks lined up.
You're getting all your ducks in a row, and we're giving you the option to go in and say, look, seller, I am willing to waive my financing contingency. If I don't get the loan, that's my problem. It's not yours. We're still coming up with the funds to buy the house. So that is one thing I would say is available out there.
That's very valuable.
It's extremely valuable,
How do
and
people get a hold of you for that?
they can look me up on the Best of Investing website. My bio is there, and my contact information as well. I work out of the Mill Valley office of RPM Mortgage. And as Mark said earlier, I'm also available on the weekends. So
Yeah, and even though we have a lot of listeners from Santa Rosa to San Jose.
Yeah, no problem.
Just the fact that you're in Mill Valley I mean, I've done a lot of stuff like just via fax or.
Yeah, it's very easy. I can help
email.
borrowers throughout the state. So if you're listening on iHeartRadio,
Yeah.
you can get a hold of me. If you're in California, I can help directly. Yep.
Good job.
Yeah.
All right. Any last? We have about 45 seconds before we get our thoughts for the day.
Oh, just to go down on a knee and run the clock out, or
Okay. Well.
no.
That's all right. That's all right. Okay. Here we. Okay,
I'll talk.
That was a quick 45 seconds. Okay. So, you guys, we all kind of work out at the gym, right?
Yep.
We all exercise. Okay.
Yep.
So I figured out though that for the price of a 1-year gym membership, I could just replace my entire wardrobe with larger clothes, right? Just
They have a slimming
get out of
effect.
shape.
Somehow I don't think that
Yeah, I was
works
gonna
the
say-
same.
Yeah, I don't think my wife would appreciate that.
Well, a well-tailored suit might give you a few pounds back, right? I mean,
That's true. That is a good point. And if a dog is man's best friend, a cat is man's snooty, passive-aggressive girlfriend.
Yeah.
And if you have
Love my
cats,
cats.
you'll understand. I mean, I think I work for them.
Oh, but yeah. And
I have
that's
cats.
the way it should be.
I love cats.
I love them.
It's true.
Yeah, they control that relationship.
Yeah, dogs, it's amazing. They're just completely different.
Yep.
All right. Tune in next week to The Best of Investing. Why? Because we're going to be having more interesting guests, more co-hosts, more everything.
A lot of fun to be on the show.
And all
Thank you,
those
Edward. Yeah.
great free
And
vacations.
how many?
9.
9 more free vacations
We're
for
giving
answering
them away.
trivia questions. Now, you got to answer the trivia questions, though.
Oh, that's true.
We're not just giving them away. All right, audience, thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Are you insinuating? No, just dancing. Don't put that in. Welcome, you're listening to The Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing mortgage investment firm, and Patty Cohn of Pacific Union. Our phone number is 888-912-1190. If you forgot to wave to the camera. There we go. All right, we're giving away 9 vacations during this show. Now, the vacations are not sponsored by the radio station, but by Lighthouse Resort and Marina, located 1 hour northeast of San Francisco. Today's trivia theme is Disneyland.
Nice.
Okay, some of these questions might be easy, and some may be difficult. All righty. Patty, let's just get right in with you. You've got some interesting information for our listeners.
Yes, actually, Edward, it's a great market. Everybody knows prices have gone up and everybody knows it's a good market. So specifically, what do we mean by that?
Okay.
So when I looked at the last 60 days, comparing this year to 60 days last year, Napa is on fire.
Oh, really?
Absolutely.
What any specific part of Napa?
All over. Old Town is a good buy, by the way, because
Okay.
they're doing a lot of regentrification and a lot of changes in Napa right now. Good time to buy. What's actually moving really strongly in Napa is the high-end stuff.
Okay.
So when I looked at, average days on the market, list price to sales price, all those numbers, and as hot as Napa is, the list price to sales price is still at, 98.5%, as opposed to in Marin, for example, it's
Over 100% because it's being overbid. Okay.
1.5 over asking on average.
1.5?
1.5% on average.
Wait, does that mean
1.5%.
No, 1.5%.
Oh my God!
Yeah, yeah. I know, I know.
50% over. Okay, there we go. I got it.
But that's just
San
an average.
Francisco.
Yeah, really.
Yeah. And San Francisco's hot, but everything has slowed down a lot, and it's this time of year anyway.
Yeah.
But Napa's really on fire, and
Now, what do you attribute that to? Is it just because it lagged for lower prices to begin with?
yes,
Okay.
I think so. And in fact, everything goes north. So
Okay.
everything happens in San Francisco first, and then it'll hit Marin, it'll hit Sonoma, it'll hit Napa.
I see.
So by the same token, things are starting to calm down and slow down a little bit because we took some big fat gains in the last 18 months. And it's healthy to have it calm down a little bit.
Yeah, exactly.
Right?
This is same thing with the .com situation where it just went up way too fast, and so then you had the .bomb after that. Yeah, it would have been better to be steady.
Exactly. And in terms of number of sales, though that's dollar volume, but in terms of number of sales in the same period last year, Marin, same number of sales sold. Sonoma, 21% more sold. Napa, 24% more sold. So it's just a trend going out north, and it always starts in the city.
Yeah.
Yeah.
Well, and they just released, I've got a graph that I brought along with me from First Tuesday showing California underwater homes. And we've been, we've been talking about this for months and in fact years about the percentage. And so a year ago in the first quarter of 2013, we had 21% of homes underwater. Now, we're not even talking about the homes that are, that have basically zero or just a little bit of equity, not enough to sell, but that are still actually underwater. And that's been cut in half. We're now down to 11%. Interestingly enough, First Tuesday, and those who listened before us talk about First Tuesday, they are a educational-based website that has been predicting softening of prices. They actually see this as a low right now for the short term, and that we might actually see a bump back upwards. Right now we're at about 750,000 homes in California still underwater, and they predict that actually might increase back up to 1 million by this time next year, because they're continuing to predict that the market has overheated in many, if not most, markets of California, and that we could see a softening of prices as much as 10 to 15% over the next 12 months.
Well, it looks like interest rates don't look like they're going to go up anytime soon.
They don't.
So it's interesting. I was just reading an article actually in Thursday's paper about homeowners are now starting on long-delayed remodel projects. So one is the fact that they are more convinced that the economy is getting better, and I guess the real estate market's gone up enough to where they feel comfortable, taking more of an equity line. Right?
Yes.
Would that be it?
Well, and then the other side of that is actually getting an equity line now
Yeah.
is easier than it was before, and that's largely thanks to the fact that the refinance boom is essentially over. And those in the mortgage business will know that the last 10 years have been a great time to be in mortgages from the refinance perspective. If you are an expert at refinancing, you may have customers you refinanced 4 or 5 times because we kept having these new lower lows. Well, after last year's low in the mid to high threes, we're not likely to see that refinance boom again. And so that refinance activity is gone. Now it's purchase activity, and so the banks are looking for products to bring back out, and so you're starting to see subprime, home equity loans, other types of things. Now it's still not as easy to get money from a bank as it was in 2005 and 6, but it's, again, they need the revenue. They need to generate loans, and so this is one way that they're doing it, is that home equity loan products are now coming back out again.
But you wonder, is that part of why we got into trouble to begin with?
Yes,
as
it
a-
is.
as a country?
Are you saying that we never learn from history and we keep repeating mistakes again and again?
Well, let's see. You had World War I, then you had World War II. So yeah, I'd say so.
And another reason why is people actually have equity now.
Yeah, and that's why we're talking. That's why I brought it up, because some
Yeah.
people are still underwater.
Yeah.
But again, there's been a huge boom for a lot of areas.
Right.
Yeah.
And even people, I mean, there's a lot of people in Marin that didn't really have equity, but they had the money. They could have poured money in their house and
Yeah.
updated it. But when you're gripping the sides with like a deer in the headlight because where's
Yeah.
my house going, up or
Exactly.
down,
Yeah, I
you don't
wanna-
really value it as much.
Well, that's a good point. I mean, if you're right at the tip, value versus the loan that you have, you may not want to sink another 100 or 200,000 into it. You may think, maybe it's time to sell.
Yeah.
Yeah,
Or do
that's a
I
good
want to
point.
make this pretty for somebody else and give that $100,000 next year when it's worth $100,000 less?
Yeah.
But right now, people are confident.
But the construction industry is kind of booming right now.
Oh,
because
boy.
yeah.
So
Hard-
many of those guys didn't make money, and they lost their shirts, they left the state, whatever.
Yeah.
People, the contractors really were down for a
Yeah.
long time, and they're back up now.
I was gonna say, try to get a hold of some of them, and you may not even get your phone call returned for a while.
Well, I think booming is relative. It's certainly not the way it was during the home building boom of the early to mid 2000s. But we've seen construction lenders are starting to come back in. At Pacific Private Money, we're getting a lot of requests for new construction, infill construction, small subdivisions that people are picking up from the owners that have been sitting on them since 2007 when the market turned. So that activity is slowly but surely coming back. One interesting note, because we did talk about the number of homes underwater is declining. There's an interesting quote in the article here that says, because again, we still have $750,000 homes, or 11% of homes with a mortgage in California that are underwater. How long is it going to take? What's the prediction for when that's going to cure itself? And according to this article on First Tuesday, they're predicting not until 2020.
Wow.
So
That's amazing.
that's a long time for people who are stuck underwater and refuse to strategically default, bless their hearts, that they can look forward to, if you want to phrase it that way, 2020. That's another 6 years.
And really, the truth is, unlike any other kind of investment, residential real estate is emotional. And I talk
Yeah.
to people every day, well, not every day anymore, but many, many people over the years, their house is worth like half of what they owe. But they still want to refi it at the same price. And I have to ask them, would you buy it today at this price?
Yeah.
No way.
Yeah.
Well, that's what
It's-
you're doing.
exactly.
But they care about it. It's the heart, it's the home, it's your family.
Well, it's funny too, because I've done the analysis for some people where they think, yeah, oh man, my house in certain instances where they said, oh, my rate of return was fantastic. I said, well, wait a minute, you bought your house in 1960 for $40,000, and now it's worth $1 million, and you do the math. And it's not, they think they probably made, 80% a year, and the compounded rate is maybe, 6%.
Right.
So it's not terrible.
Yeah.
But it's not the rate of return they thought. So now we're going to cut to our first commercial break. Here is the trivia question again. The theme is Disneyland. Get ready for this one. Okay, the Blue Bayou Restaurant is located in what famous Disneyland ride? All right. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Their website is lighthouseforfun.com. Call 888-912-1190. That's 888-912-1190 to answer this question. The Blue Bayou Restaurant is located in what famous Disneyland ride? All right, don't touch that dial. The Best of Investing will be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and our latest co-host, Patty Cohen.
Indeed.
All right. First commercial break trivia question. Again, the theme is Disneyland. The Blue Bayou Restaurant is located in what famous Disneyland ride?
No clue.
No clue. Never been to Disneyland? No.
Many times, but not lately.
No clue is a ride.
Yeah. I know, yeah, no, very good. No, Pirates of the Caribbean. Remember how you go through Pirates of the Caribbean, you look to the right, there are people
That's
sitting there,
right.
that's the Blue Bayou Restaurant. Okay, I figured I'd, give you something, rather than just, where's Space Mountain located? So Patty, you've got an exciting little story there about so much house going way over asking.
Well, yeah, I mean, there's a lot of them. For example, way more than 50% of the houses in the Bay Area go at or over asking.
More than 50% are going over asking.
Way more than 50%.
Wow. That's
Exactly.
amazing. Okay.
So then I thought, let's just look at those that go at 5 or more percent over asking. And I
Okay.
just took a snapshot, and there's 21%. And actually, you think, well, they're bidding on these little condos for 200, 300, 400.
Yeah.
No. In this snapshot I looked at, 76% of them are between 750,000. Excuse me, 700,000 and 1,750,000.
Yeah, I was gonna say, when you get over like 5 million, you don't usually get like way over asking on something like that, do you?
No, you don't.
Okay.
You don't. But though it does happen. I mean, there was a house in Ross that was listed at 339 and it went for 3,810.
Wow.
That's over 5%. I mean, but it does happen is the point. If it's really primo tall cotton location.
Sure.
So here we have this little house in Mill Valley, for
Okay.
example, on Jane Street. It's a 2-bedroom, 1 house, what I call a grandma house.
Yeah, sure.
List price $459. What would you guess would be the sales price?
559.
Right. Typically, that's how those go.
I mean, that's a lot.
705. It's a 54% over asking.
Wow.
That's amazing. Now, how many square feet was the house?
1337.
That's
yeah.
$600 a foot. How
Right.
big is the lot?
Tiny little lot, 0.11.
Are they going to just build 6 stories on top of it or something? I mean, what's the deal?
You know what? It's again, sellers are afraid to price too low, but when you see it's just think about eBay. You put something really, really low, that's the thing you start out at $1, that's the thing that's going to go over 1,000.
Yeah.
So, again, residential real estate is not always logical. It's very emotional.
Well, yeah, I mean, because $600 a foot, and it still seems like a lot. Even in Mill Valley, I don't know where. Actually, I know where that is.
You know where that is, and it's
Yeah,
not
that's
that great of a neighborhood.
No, it's just kind of okay. It's near the 2 a.m. club, isn't it?
Right.
There you go. Oh, that's why. So that the people can just drink and then just go walk home.
Yeah.
That makes
Yeah,
sense.
Exactly. And I mean, Sycamore Park is like Ross and Belvedere, 1,000 square foot these days.
Yeah.
Yeah.
So Patty, do you have any information about what percentage of these transactions are like all cash? I mean, I wonder what's driving this continual increase, because certainly at the beginning of the year I didn't, after going through a year where in many markets we were up 20%, I didn't see that as being sustainable, nor did a lot of other real estate experts who wrote about it. But in many markets we're seeing what almost feels like a runaway bubble of inflating prices in some markets, which are including Marin, San Francisco, and the Peninsula. Is that? I mean, do you have any information about is it cash offers that are driving that? Is it the tech boom that's driving that? I mean, what do you think is the factors on this?
Oh, well, yeah. Last I looked is that 42% of properties in the Bay Area were going for cash.
Well, in that Mill Valley one, it was the bar that was located right around the corner.
Right,
The
exactly.
The bar factor.
The bar factor,
Yeah.
exactly. So why are they going for cash? Well, buyers know that they have to sell their own house first. There's no contingent sales.
Yeah.
And as a culture, we've all pulled back. We're no longer like stepping up for the bigger and the better. You're almost bragging about, hey, I'm in a nice little place now. So you take your equity out, you're a move down buyer. Or the bonuses, the tech people. And let's not forget there is a lot of foreign money out there.
Yeah.
A lot of Chinese buyers that are trying to get their kids in here for the school district.
So you did make a comment that, and I heard it as unit sales were slowing, not pricing. Is that an accurate description in the higher end market, mid to higher end markets?
Right, the rate of price increase is definitely slowing, which thank God it is, because
Yeah.
we learned something is what we were talking
Well,
about.
I'd like to. I would hope so that we did, because again, you start pricing people out of the market, and then it's going to be a stall and maybe not a very pretty correction.
Right, and the true indicator of a market is what is the percentage in contract. So yes, in some cases we're having fewer sales. It's just because we have fewer inventory, and in many markets it's close to 50% percentage in contract. Anytime you're over 35%, you've got a seller's market.
A couple of weeks ago when you were on, you mentioned also about the Chinese money.
Mm-hmm.
I received a couple of phone calls from the same person who left a message, and I didn't share it with you only because she went into quite a tirade, I guess is a good word, about, she wanted to speak to somebody about that Chinese money coming in and the foreign money, and she had all these kind of interesting tidbits that I thought.
She was happy, upset,
No,
tirade,
she was
about.
very, very upset about, and trying to figure out where all this Chinese money was coming in, the import and export, and it got to a point where I said, I don't know if I want to pass this on.
Just reporting the facts, ma'am.
Yeah, exactly. There you go. Exactly.
Well, with the residential market on fire, what does that mean for the real estate investor? And I will say, again, this is just anecdotal information based on the fact that at Pacific Private Money, we specialize in making loans to the real estate investors. And 75% of our business 2 years ago was to people who were buying, fixing, and flipping
Yeah.
all over the Bay Area, mostly in Alameda County, Contra Costa County, Solano County. That activity has slowed dramatically in our office. Our flip business is now the opposite. I mean, it's swung the other way. About 25% of the loans we're making now are to flippers. And I spoke to someone who was in the business of making seconds. They were supplying the down payment, the gap financing that a lot of rehabbers and contractors were needing because they didn't have enough of their own capital to acquire and remodel this, either a house or an additional house in addition to maybe something else they have in the works. And he was saying that he's been seeing a lot of secondary lenders who were starting to lose money on projects because the pricing is getting very thin. So, or I should say, the profits are getting very thin.
Right.
So, I mean, you know, my dad used to say you can make money in real estate in any market, and it's always a good time to buy real estate. But what he really meant was that if you buy smart, you can make money in real estate still today. So even in this market, you need to know, and buying off the MLS is generally not the place to find bargains, but there are bargains out there. There's wholesalers that are being able to tie up property in contract. In fact,
Now you'll make now, even though, like you said, the fix and flip market is not being your bread and butter now.
it's slowing down.
Okay, it's mostly what, just purchase money?
It's purchase, it's refinance, it's construction. We're doing a lot more consumer loans nowadays, and you've heard us talk about all these owner-occupied purchase money, so-called bridge loans that we're doing because of conventional fallout thanks to Dodd-Frank.
That seems, to me, seems probably the safest loans that you're doing. Here's our thoughts for the day. An average American will spend an average of 6 months during his lifetime waiting at red lights. And if you live in the Bay Area, it's probably about 2 years, I'm guessing. And a female ferret will die if it goes into heat and cannot find a mate. You know, I can relate to that. I tell my wife all the time that. Okay, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations. We're answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.